All those small variations we saw in the previous scenarios are put together in this composite problem, as in part cash settlement, part debenture issue.
Also, we have been asked to pass entries in situations where debentures have been issued at par, at premium, and at a discount.
But before that, we are also introduced to the concept of goodwill. This has nothing to do with the issue of debentures, yet it is closely linked with acquisition. In that context, we are likely to come across such transactions quite often. When an investor is willing to buy assets for a consideration in excess of its book value, then it is assumed that he recognizes a value intrinsic to the business, intangible as it may be, but real, something that will fetch him returns in the future. This is termed as goodwill and is to be accounted as an asset. This being the consideration paid in excess of the book value of assets, or consideration paid in excess of the book value of net assets, that is, net of liabilities, agreed upon and taken up by the investor, as in this case. The book value of net assets in this case is 5,80,000. That is, assets rupees 6,60,000 minus liabilities assumed rupees 80,000. The consideration agreed for this, however, is 6 lakhs. The excess of 20,000 is accounted as goodwill. Now, Star Limited has also been part satisfied by payment of cash to the extent of rupees 60,000. Balance due to Star Limited is rupees 5,40,000. As we have already seen, the number of debentures to be issued to satisfy the balance debt of rupees 5,40,000 will depend on the agreed issue price of the debenture. If the agreed price is rupees 100, then the issue is at par, and 5,400 debentures will have to be issued to satisfy the debt. That is, the debt being 5,40,000 is divided by 100 being the issue price. The journal entry reads as vendor account debit to debenture account credit. When debentures are issued at a premium, it should be obvious that a lesser number of debentures would satisfy the debt. The working note indicates that only 4,500 debentures need to be issued. That is, when the debentures are agreed to be issued at a premium of 20%. The debt in excess of the face value of debentures that has been issued in satisfaction or discharge of the debt is a capital gain for the company and is accounted as securities premium reserve account. The journal entry to record the discharge of the balance of the purchase consideration reads as vendor account debit to debenture account credit to securities premium reserve account. We have already seen that when the issue is at a discount, more number of debentures have to be issued to satisfy the same debt. The working note indicates that 6,000 debentures have to be issued when debentures are issued at a discount of 10%. The difference between the debentures issued and the debt that is satisfied is a loss to the company and is accounted as discount on issue of debentures. The journal entry: vendor account debit, discount on issue of debentures debit to debenture account credit.